So today I just want to look on variance analysis. And when you look on variance analysis, you basically find that is a technique. Is it a technique of analyzing? It is a technique of analyzing the total variances. The total variances into its components. Into its components, so as to determine the responsibilities and assign them the responsibility that you assign them to different managers. We just assign them to different managers. It is normally used by the top management. It is normally used by the top management. It is basically used by the top management as a way of evaluating the performance. Evaluating the performance. So why do we normally have to study variance analysis? Or why do we have to come across this kind of a problem? And I will be able to say during the preparation of budgets, there are some of the prices of the commodities or materials that we normally put under the budget. But when you look on the analysis, you normally find that due to some aspects of economy, like inflation and demand and supply, the prices of commodities, I think you can be able to hear me, the price of commodities can skyrocket, or they can reduce the prices due to its supply in the market. So basically, for instance, when we look right now, we are affected by a lot of aspects, and one of the key things is that we are looking on the determination or stabilization of our economy to avoid or to be able to avoid the aspects of high standards of living. Now, in this case, you are going to be having to look at why do the price of commodities has to rise? And it means that if they become scarce, right, in the market, then the price of the commodities will be high. When you come back to the production aspect, you will be able to find that during the production, we need to buy materials, but we are going to be buying within our budget. We remember there is a budget that because the budget is just normally set so that it can be able to motivate and give a leeway on where do we want to be at the end of the financial year. Now, when you look on our case here, why are we supposed to be investigating variances? Is because if, for instance, you budgeted to go and buy a dress for a certain function, like 1,000, and when you go to the market, you find the dresses is coming like 1,500, right? The difference of 500 is the extra cost that you're going to be incurring. When it comes to the variance, the 500 is adverse, meaning it is the extra cost that I was able to incur, which was not budgeted. When you look on the aspect where I go to the market, I was going to buy a dress. My budget was 1,000, and I find those dresses which under my consideration is trading at 800 shillings. Then it means I was able to save 200 shillings from our budget, and that is why in variance analysis we normally say it is called adverse. Now, to be able to encounter the types of variances, I just want to look on the question which I shared on our WhatsApp group. So there is a question which I shared there. Let me share also with you. And Farah will start by reading for us. So let me see. So there is a question here. May 2012 question 4B. Someone can read. Go on.
The standard cost per unit for the month of April 2012 was as follows. Direct materials, 5 kilograms at shillings 2 per kilogram. 10. Direct labor, 4 hours at shillings 5 per hour. Variable overheads, 4 hours at shillings 1 per hour. Fixed overheads, 4 hours at shillings 10 per hour. Total standard cost 74. Additional information, budgeted production was 2,000 units, while the actual production was 1,800 units. The following were the actual costs for the month of April 2012. Direct materials, 12,000 kilogram. Direct labor hours, 9,800 hours. Variable overheads, fixed overheads, total cost. Required material price variance and material usage variance, labor rate variance and efficiency variance, fixed overhead volume variance and capacity variance, variable overhead expenditure variance, and efficiency variance.
Very good. It is a good question where we are going to be learning all the types of variances that we have and which are basically tested under your cases here. And I just want to be able to show you how you compute it, how it is being computed. I think it is May 2012 question 4B. And I'm just going to be starting by looking on the different groupings of variances. Number one, we are going to be starting with material cost variance. Material cost variance. And in this case, when you're looking on the material cost variance, it means you are going to be analyzing the materials. So number A, we are going to be analyzing the material price variance. The material price variance, which is basically called the MPV, right? Which you normally get it by taking the standard price, right, minus the actual price. Then we multiply by the actual quantity purchased, right? So in this case, you might be finding in my formula writing SP minus AP, right? We multiply by AQ. Now, from there, we need to be analyzing the material prices. And this is the case we have to be looking on the budgeted minus the actual. We get the variance. Why is it varying? So in this case, when we go back to our question, just look on the standard prices. So how much was the standard price given by the examiner per unit? Let me check here. So we are being told that ABC Limited is able to produce a single product branded Z. So the standard cost per unit. So you are given a standard scorecard. And in this case, we are looking per kilogram. So the standard price should be per kg. And in this case, when I look on the standard, the examiner is giving you 2. The actual price, I go to the additional information and they will be able to find the actual scorecard. The examiner has given me for direct materials the total 26,400 and then the number of kilograms which were purchased. So to get for 1 unit, I'm going to be taking the total 26,400 divided by the number of kgs which were purchased, 12,000 kgs, right? 12,000 kgs. Then you multiply by, because here you're going to be getting actual price per 1 kg. Then you multiply by the actual quantity, which is 12,000. Now, in this case, it is 2 minus, right? How much is this? I just say 26,400 divided by 12,000. I'm getting 2.2. I multiply by 12,000. How much is this? So 2 minus 0.2 minus 2.2, sorry. I'm getting negative 0.2 times 12,000. I'm getting 2,400. It means I was able to incur more than my budget. I budgeted 2 shillings, but I was able to incur 2.2 shillings. So it means there was an extra expense or expenditure of 0.2. So in this case, we say it is normally called adverse. This is basically called adverse. Means I spent more than what I was anticipating to spend. B, now, we normally calculate the material usage variance. And when you look on the material usage variances, we are going to be looking on the usage. So look on the standard quantity, which was budgeted, minus the actual quantity. Then you multiply by standard price, right? So to get for the standard quantity, you are going to be taking the standard quantity per unit, because the examiner will not give you, times the actual units. Actual units produced. Now, when I look on your case here, the standard quantity per unit, how much are we going to be, how many kilograms are we going to be using to make 1 unit? The examiner has given me 5 kgs. And then when I go to additional information number 1, the budgeted production was 2,000 units, where the actual production was 1,800. So how much am I getting here? So 1,800 times 5, getting 9,000. 9,000 hours. So to get not the hours, but 9,000 kgs, that is what we budgeted. When you go to the analysis, you just need to be comparing the 9,000 kgs, which was budgeted, minus the actual kgs, 12,000 kgs, right, which we were able to incur. Then you multiply by the standard quantity, the standard price, which is 2. Now, in this case, when I look on, we were able to spend more materials than what we budgeted with 3,000. Then you multiply by 2, getting 6,000 adverse. So to get the material cost variance, you normally take the material price variance plus the material usage variance. So the material price variance of ours, we have the material price variance 2,400 adverse, plus now the material usage variance 6,000 adverse. On back of your mind to know all these are negatives. Now this is translate to 8,400 adverse. 8,400 adverse. That is how you do the material cost variance if the examiner is going to be asking, right? I just want to proceed by doing the other type of variance, number two, right? So for the second one, we talk about labor cost variance, which is normally written like this. So I'm going to be saying, to get the labor cost variance, I need to be taking the labor rate variance plus labor efficiency. The labor efficiency variance. So the biggest question is, how do I normally get the labor rate variance? And I remember we are comparing the rates, right? So it means I have to be taking the standard rates minus actual rates, right? Then we multiply by actual hours paid, right? So in this case, I go back to my question. What was the rate which we budgeted? I can see under the direct labor, we have 4 hours at 5 shillings per hour. So it is 5 minus the actual. I go to additional information and I find the actual standard scorecard. And I can find the examiner has just given me the total 44,100 total cost. We divide by, right, the total hours incurred, which is 9,800. Then the actual hours which we were able to pay is 98. So how much it is? I just say 44,100, right? Divided by 9,800. I'm getting 4.5, right? So 5 minus 4.5, we are getting 0.5, which is positive. Then you multiply by 9,800. I'm getting 4,900, which is favorable. Why is it favorable? I was projected to spend 5, but I was able to spend 4.5. So I was able to save 0.5. So the total amount I saved is 4,900. Let us go to labor efficiency variance. So to get the labor efficiency variance, you're going to be looking on the hours. So you look on the standard hours minus actual hours, then you multiply by the standard rate there. But to calculate the standard hours, because it is not given, I'm going to be taking the standard hours per unit. I multiply by the actual hours, or the actual units, actual units produced. So in my case here, the standard hours, how many hours do we make to do we budget to make 1 unit? I can see it's 4 hours per unit times the actual units which were produced is 1800. How much it is? It translates to 7200 hours, right? Now, to get to your labor efficiency variance, I'm going to be taking 7200 hours minus the actual hours. How many were the actual hours? 9800. You see, you're able to spend more hours than what you budgeted. The standard rate of hours is 5. So what is our labor efficiency variance? So 7200 minus 9800 times 5, getting 13,000, which is adverse, right? Which is adverse because you are able to incur more than what you budgeted. Now, when I look on the labor cost variance, we are going to be adding the two, the labor rate variance, which you are able to get as 4,900, which is favorable, plus 13,000, which is adverse. At the back of your mind, you know 13,000 is negative, it is positive. So 4,900 minus 13,000, I'm getting 8,100, which is adverse. 8,100, which is adverse. Now, when I go down to number 3, because I just want to go to number 3 now, because I have done 2. So I just proceed to number 3, just doing it slowly so that you can be able to understand it. Number 3, we normally have variable overhead cost variance. So it is normally written the variable overhead cost variance. So to get the variable overhead cost variance, you normally take the variable overhead expenditure variance plus the variable overhead. We add the variable overhead efficiency variance. Variable overhead efficiency variance, right? Now, in this case scenario, right? In this case, now we have to be asking, how do I normally get the variable overhead expenditure variance? So I just say to get the variable overhead expenditure variance, we are going to be taking the variable overhead rate per hour. We multiply by the actual hours minus actual variable overhead, right? What is the variable overhead rate? Our rate per hour, the variable overhead rate per hour. And you remember we are dealing with the direct expenses now. That is where we talk about the variable overheads. Because you know the overheads, these are indirect expenses. Now, in this aspect, the variable overhead is per the question there, which was budgeted. By the way, it should be the budgeted variable overhead rate per hour, which as per the examiner has given us 1. We multiply by the actual hours. How many hours? The one that you budgeted. The one that we were able to incur, which is 9,800, minus the actual variable overheads. How much is the total variable overheads? 9,000. So it means in this case, we budgeted for variable overheads to be 98, but we were able to incur 9,000. We have a difference of 800, which is positive, right? Because we incurred less. So that is why it is favorable. When you go to the other one, the variable overhead efficiency variance. When you talk about the efficiency, remember we have already dealt with the labor efficiency variance. So the formula is the same. Standard hours minus actual hours. Mahali popote tu nasikia efficiency, this is what you normally put in. Then consider the type of variance that you are doing. So we are doing the variable overhead efficiency variance. So we are going to be multiplying with the standard variable overhead rate per hour. So in this case, we were able to get the standard hours at 72 actual hours in 98. Then we have the variable overhead rate per hour, which we know very well is 1 because it is the one which is budgeted. So how much is this? I just take 7,200 minus 9,800, getting 2,600, which is advance. Now let us get the variable overhead cost variance. I'm just going to be taking 800 of mine, which is favorable, plus 2,600, which is adverse, right? So 800 minus 2,600, we are getting 1,800 adverse. 1,800 adverse. I just now want to proceed to number 4. Just want to go to number 4 now, where we are going to be discussing about another type of variance here. And this kind of variance, which we are going to be discussing, number 4, it is normally called the fixed overhead cost variance. The fixed overhead cost variance, right? So to get for the fixed overhead cost variance, we normally take the fixed overhead expenditure variance plus the fixed overhead volume variance. Volume variance. So in this case, it means the fixed overhead expenditure variance. We are going to be getting it by taking the budgeted fixed overheads, minus actual fixed overheads, right? But the examiner has not given us the budgeted. Kama hajakupea, no worries. Just say the budgeted fixed overheads is equals to, we normally take the budgeted cost, budgeted fixed cost per unit, we multiply by the budgeted units. We multiply by the budgeted units. Now, in this case, the budgeted fixed cost per unit, remember we are not discussing per hour, it should be per minute. So the fixed overhead is given 4 times 10, which is 40. So the examiner has given here 40 times the budgeted units. Now the budgeted units was 2,000. This translates to 80,000, right? Those are 80,000. Now in this case, to get the fixed overhead expenditure, the budgeted is 80,000 minus the actual fixed overheads. When you look on the actual fixed overheads, the examiner was able to give you 100,000. This translates to 20,000, which is adverse. You are able to incur more than what we budgeted, right? Now from there, I just want to focus our attention in the calculation of the fixed overhead volume variance. And we normally have 2 formulas. So let me start with the first one, fixed overhead volume variance. So you can take the fixed overhead cost per unit, then you multiply by, right, budgeted units minus actual units. Now in this case, right, when I look on the fixed overhead cost per unit, we were given 40. So in this case, it is 40 times the budgeted units as per the additional information is 2,000 minus the actual units, which are 1,800. So this translates to how much? We were trying to spend 2,000, but to spend less by 200. Now this translates 200 times 40,000. 40, sorry, translates to 8,000, which is favorable. Now to get the fixed overheads, the fixed overhead cost variance, we are going to be taking 8,000, which is favorable, plus the other one, which is how much was the other one? Right, 20,000, which is adverse. And in this case, we are getting around 12,000 adverse. 12,000, which is adverse. Now, I just want to use another formula in the computation of the fixed overhead volume variance. And the criteria which we are going to be using, right? Or the things that we are going to be applying here, they might be a requirement in a question. There might be a requirement in a question. There might be a requirement. For instance, we are discussing about to calculate the fixed overhead volume variance, where we can be able to take the fixed overhead capacity. Capacity is basically interpreted differently than the other variances. The fixed overhead capacity variance, right? Plus, we normally had the fixed overhead efficiency. The fixed overhead efficiency variance. So I just want to start with the first one, the fixed overhead capacity variance, which you are going to be taking the fixed overhead capacity variance. You normally take the budgeted hours minus actual hours, then you multiply by the fixed cost per hour. That should be the budgeted fixed cost per hour. And in this case, when you are discussing about it, just understand that the examiner is not going to be giving you the budgeted hours. So to get the budgeted hours, you just need to be taking the standard hours per unit. You multiply by the budgeted units. Multiply by the budgeted units there. So when I look on the standard hours, the fixed overheads, we have 4 hours per unit. Then you multiply by the budgeted units, which were 2,000. This translates to 8,000 hours. Now, to get the fixed overhead capacity, I take 8,000 hours minus 9,800 hours. Then you multiply by the budgeted fixed cost per hour, which is 10. Fixed cost, the budgeted fixed cost per hour, which is 10 shillings. So 8,000 minus 9,800, you multiply by 10, getting 18,000. Getting 18,000. So the interpretation here, I have said it is different. In simple terms, when you get the positive under the capacity, it is favorable because you incurred more hours to make your product efficient. Now, if you use less hours than what you budgeted, that is adverse because you used to better your product, you use less hours to better your product than how it should be. When you incur more hours in capacity, it means that it is good for the organization. Now, let us go to the fixed overhead efficiency variance, which you are going to be taking the fixed overhead efficiency variance. We are going to, when we hear the word efficiency, you just need to be taking your standard hours minus actual hours. Then you multiply by the fixed cost per unit, per hour, sorry. The fixed cost per hour. Now, the standard hours of hours, ukikumbuka tukifanya labor ilikuwa 7,200 minus actual hours, which were 9,800. We multiply by the fixed cost per hour. So the fixed cost per hour is 10. So how much is this? This is the same as how we were interpreting the same variances. So 7,200 minus 9,800, we multiply by 10, getting around 26,000, which is adverse. So in this case, we just say to get the fixed overhead volume variance, we are going to be taking 26,000, which is adverse, plus 18,000, which is favorable, right? This translates to 8,000, right? 8,000, which is adverse. That is what we were able to get under our first formula that we did. Now, the last one, right? The last formula for variances, which is not part of the requirement in this question. Remember, I have already done all the requirements as per the question. But number 5, we normally talk about sales cost variance, we normally, to get the sales cost variance, we normally take the standard sales variance. I will just be able to confirm this for you sometime later. For the last one, I don't remember the formula as well, but I'll just be able to share with you later. That does not have any problem. In case we have any question, I just want to shift my gears to do another question, basically for reconciliation, so that you can be able to understand better, because I'm remaining with another 2 questions. So let me rush to May 2016, right? Question 2A. May 2016, question 2A. May 2016, question 2A. Now, for the sales, I will just be able to share those formulas in the WhatsApp group, but at your level, they are not mostly tested. So, in case the examiner feels it is the right time to test them, then I'll share with you so that you don't have much issues during your exam time. So let us go to 2016. 2016 here. 2016. So we are discussing about May 2016, question 2A. Question 2A, management accounting. During these days, it was a junior paper. Now, good. Question number 2A. So give me 1 minute, please.
Yes. Limit Price Enterprises Limited manufactures food products. The details of the manufacturing cost of one of its product branded term is provided below. Standard cost per unit. Material 6 kilograms at shillings 480 per kilogram. Labor 4.8 hours at shillings 800 per hour. Additional information. The actual cost for the month of April 2016 was as follows. Materials 59,000 kilograms at shillings 500 per kg. Labor 47,500 hours at shillings 900 per hour. The actual production amounted to 10,000 units. The variable production overheads are absorbed at 50% of the direct labor cost required. The material cost variance, the labor cost variance, the constitution of standard and actual cost in.
Very good. Now, very good. I know that these are the things that we have already done right now. And when you look on them, they are not difficult because this is what we have done. But I will just be doing the questions since the examiner is talking about reconciliation aspects. And when I look at it, we can be able to do it very quickly since it is not a hard question. So in this aspect, we are just going to be analyzing our standards and the actuals to get the differences in variance. So I just want to start with the material cost variance. Let us go back to our board. So in this case, remember the examiner wants us to calculate the material cost variance. The material cost variance. So we know very well, to get the material cost variance, we normally take the material price variance plus the material usage variance. So to calculate the material price variance, right, we have said, let us compare the prices. So the standard price minus the actual price, then you multiply by the actual quantity. So as per the examiner, what is our standard price? What is our standard price? Let us go to the question. So the standard price given here, right, the examiner has given us that the standard price per kilogram is 480 minus the actual price. So the actual price is an additional information number one. I can see the examiner is saying for materials, it is 500. Then we multiply by the actual quantity. How many kilograms were we able to purchase? We just say 59,000. 59,000. So how much is this? So I just say 480,000. Sorry, 480 minus 500, we get negative 20. So we incurred more by 20 shillings. Then we multiply by 59,000, getting 1180,000. This is adverse, right? Now, let us go to the material usage variance. And we say the usage look on the quantity. I just talk about the standard quantity minus the actual quantity. Then we multiply by the standard rate, the standard price, right? So to get our standard quantity, we are going to be looking on the standard hours per unit. Then we multiply by the actual units produced. So in this case, when you look on the standard hours per unit, how many were this our hours incurred to be incurred per the standard cost, right? We have talked about the standard quantity. It is not the hours. Sorry for that. I don't know why I'm focusing on time. So the standard quantity per unit. When I look per unit, I was able to incur 6 kilograms to make 1 unit. We multiply by the actual units produced. How many units were produced? The actual units produced is how much? As per the examiner is saying that the actual production amounted to 10,000, right? So translate to 10,000, which is equivalent to 60,000 kgs. Now, in this case, we look on the standard quantity. Now we have gotten it 60. The actual quantity, I can see it was 59,000. We were able to save at 1,000. Then we multiply by the standard price, 480. So 1,000 times this one, 1,000 times 480 translates to 480,000. This one is favorable. Get your material cost variance. We are going to be getting it by taking 1180,000, right? Which is adverse. You add the other one, which is 480,000, which is favorable. What is the difference here? Now, in this case, I just say 1180,000 minus our answer, because we are going to be getting 700,000, which is adverse. Let us go to number 2 now, because this is number 1. Number 2 here, examiner wants us to get the labor cost variance. Examiner wants us to get the labor cost variance. The labor cost variance. The labor cost variance. We have said to get for the labor cost, just take the labor rate variance plus labor efficiency variance. We said to get the rates, we have to be comparing the rates. To get the labor rate variance, we have to be comparing your rates. So it's just take the standard rate minus actual rate, then you multiply by the actual hours. Now, in this case, the standard rates, how much were we charging or being charged per hour? We budgeted for 800 minus the actual hours, when as per the question, it is 900. We multiply by the actual hours. So the actual hours, I can see it is 47,500. So this translates to how much? You can see you incurred more hours than what you budgeted by 100. So it will be 47,50,000, which is adverse. When I look on the labor efficiency variance, we said just take your standard hours minus actual hours, then multiply by the standard rates. Multiply by the standard rates. So you ask yourself, how do you normally get the standard hours? I said just take the standard hours per unit, multiply by the actual units produced. The actual units produced. So the standard hours per unit is how much? The standard hours. Let us go to our standard scorecard up there. I can see it's 4.8. We multiply by the actual units, we produced 10,000. This translates 48,000 hours. So to get the labor efficiency variance, you're going to be taking 48,000 hours minus the actual now. Which were the actual 47.5, right? We were able to save 500, now we are happy. You multiply by the standard rate, which is 800. How much is this? So you just take 500, which we are happy with. So 500 times 800 translates to 400,000, which is favorable, right? Now, in this case, we just need to say, to get the labor cost variance, you're going to be taking, the first one was 47,50,000, which is adverse, plus 400,000, which is favorable. How much am I getting here? So I'm getting 4350,000, which is adverse, 4350, which is adverse. Now from there, let us shift our gears to do reconciliation. So to come up with a reconciliation statement, you reconcile between the budget statement. So in this case, let us look on the budgeted, how much we budgeted to incur for both. Now, I remember very well, 1 kg, we budgeted for 480. The standard rate for material was 480. We multiply by how many units did we budget to produce? Which were how many units did we budget to produce? When you look on the standard quantity, we were budgeting 60,000 kgs. So I multiply with 60,000 kgs. Plus, when you look for labor you budgeted, when I look on the question here, the standard rate to charge per hour was 800. Then you multiply by how many standard hours do you have? When I look at it here, we were able to calculate our standard hours at 48,000. So what is the total budgeted cost statement looks like? So it will be 480 times 60,000 plus 800 times 48,000, right? So I'm going to be getting 67,200,000. 67,200,000. So come here and analyze your variances. Kama tungekuwa na mingi kama za zile type, you can come here and you write down here, you just say, we have adverse, we have favorable, right? So nikiangalia labor cost variance, ndio unaekanga hapa, hizi costs, not about the specific variances. Unaeka kama, let us start with the material cost variance. So our material cost variance tulipata 700, which is adverse, unaieka hapo. Right? Then, when you look on the labor cost variance, tulipata ngapi? 4350. Right? Remember, hatukuwa na adverse yoyote. Tungekuwa na favorable, hatukuwa na favorable yote, tungekuwa nayo, tunge offset our adverses, zenye zingekuwa zina exist, then tunaweka the difference here. So hapa ni 0. Now in this case, when you add both, you are getting 50-50. So in my case here, let me put 50-50. Sasa hapa ndio wanafunzi wanakuanga confused kabisa. Why do we have to add to our budget? Because when we are discussing about the adverse, inamaanisha budgeted yetu ama the budgeted cost yetu ilikuwa 67,200, but now we incurred more than what we budgeted. When you look on the adverse, you understand you incurred more. If it was favorable, it means if we were budgeted for 67 and this figure of 50-50 comes from the favorable, it means we incurred less. We were able to save. So what is our actual budget? That is the thing that you're supposed to be asking. The actual budget should be more than what we budgeted. In our case here, when you have more adverses. Now, it's just taking your budget figure, you add the adverse. So it will be 67,200 plus 50,000, translating to 72,250,000. 72,250,000. 72,250,000. 72,250. That is how you normally carry out the analysis for variances. If you can go, for instance, if the examiner brings the question of profit, the actual profit, I wish we could be having one, and I will be able to show you here how you normally come up with our budgeted profit. You look on your variances. Then when you come with the actual profit, by the way, the actual profit is always given in the question. I think that is the aspect you're going to be coming across ukipanda pale juu when you go to the advanced level. Now, I just want to look on a different setup of a question. And this question was set on November 2015, question 4B, right? November 2015, question 4B for variances. So we look on November 2015, question number, it should be question number 4B. It should be question number 4B. Question 4B. Question 4B. So let us go there. So November 2015 here. So someone to read for us, you can see is a good question. Someone to read, please.
Qual Limited manufactures a single product branded Q. The standard selling price and variable cost per unit of product Q are as follows. Selling price 106, materials 2 kilograms at 10 shillings per kilogram, 20, labor 3 hours at shillings 24 per hour, 72 shillings. Additional information, budgeted sales for the month of October 2015 were at 8,000 units. The actual result for the month of October 2015 was as follows. Production and sales at 6,000 units. Selling price per unit shillings 134. Materials 76,000 kilograms at shillings 734,000. Labor 114,000 hours paid at shillings 2,656,000. The company operates a standard costing system and adjusts in time purchasing and production system. Required, showing applicable variances, prepare a statement that concerns the budgeted contribution with the actual contribution for the month of October 2015.
Very good. When I look at it, we will be able to find that the examiner is giving us the selling price there, the material and labor. And before even I do any reconciliation, I just want you to understand what is our actual budget as per the information provided by the examiner up there, because the examiner is telling us not the up but down here. We are being told that under the actual results of the month of 20, because we are supposed to be reconciling between our budgeted and our actuals, I just want to determine the answer which once I reconcile nitapata ngapi. So wacha nione kama examiner amenipea some aspects which will be assisting me to get that actual answer, the actual profit rather. Now, let us go to our board. Let's go back here. And I just start by doing workings, very simple. I just want to determine, is it possible to get this answer? Because this is what we are supposed to be getting. So workings. Now, in this case, let us look on my workings in this case. Because I just want to look on the actual profit. What is my actual profit? Yenye nikireconcile hiyo kitu ndapata. So aje nikuwe na column tuwili hapa. Let us test with sales, because I think this information is provided in the additional information. So our sales, as per the question, the production and sales we are being given at 6,000 units. Then the selling price is 136. Right? 134, sorry, is 134. So how much is our sales? So in this case, I just say that 6,000 times 134. I'm getting 24,000. Then let us less our cost. So our cost, I can see we have material costs. Our material cost translates to how much? You can see the examiner has given us 754,000. Then we have labor cost. Right? Our labor cost translates to 2656,000. So how much is this? So let me just say 754,000 plus 2656,000, which is 3410. What is our actual profit? So you take 48,24,000 minus our answer here. And this is what we are supposed to be getting, by the way. Once we reconcile, this will be our answer. So that is something that you're supposed to be understanding. That is what the examiner is asking. Can you be able to reconcile to get these actual profits from the data which he has already given you? Now, to do that, let us start the reconciliation statement for the month of October 2015. Reconciliation statement for 2015 October. Let us start from there. Now, in this case, we just need to be having two columns here. We have the columns of Kenya shilling there. Right? And then we are going to be starting by looking on the data provided by the examiner. Let us start by looking on the budgeted contribution. What is our budgeted contribution in the question? The budgeted contribution. The contribution provided there by the examiner, right? It is taking, because I can see the selling price provided by the examiner is 136. Minus 20, minus, because these are the variable cost, 72. Getting equivalent to around, how much it is? 136 minus 92. Getting 44, right? So 44, we multiply by the budgeted units. How many were our budgeted units, right? We have been told the budgeted sales for the month of October 2015 were 38,000. Times 44. Sorry, 44 times 38,000. Getting 1672,000. 1672,000 there, right? Now, from there, we just need to be looking on the aspect where the examiner is telling us there is a sales volume variance somewhere. So, under the contribution, because what is the difference between what we budgeted and what we were able to sell? So, because we need to be getting our actual, our standard, we need to be getting our standard contribution on actual sales volume. But when you look on the number of units that we were able to sell, we sold at 6. But our budgeted contribution is 38. I just want to be able to subtract the variance. So we look on the sales volume contribution. Sales volume contribution variance. So what is the variance arising here? You are able to sell the actual unit that you sold is 36. You budgeted to sell 38,000, right? Then you are going to be multiplying with a contribution per unit, which is 44. So 36, this is the difference of how much? So that 6,000 minus 38,000 times 44, getting 88,000. 88,000. And considering this is adverse, right? Considering that is adverse, what we are supposed to be looking at is the standard contribution. Standard contribution on actual volume, on the actual volume sold. So how many units actual sales volume? It should be like that. So how much it is? So I just need to take plus 16 72,000. I'm getting 1584,000. 1584,000, right? From there now, let us analyze our variances. And I'll start with the sales price variance, right? The sales price variance. And when I look on the analysis of the variance is because when I look on the ledger which is provided there by the examiner. Now, the sales price variance, because this is price, the sales price variance, right? You are going to be taking, because I told you I will be able to get the formulas, the standard price, you look on the standard price minus actual price. This is not the standard, this is the standard, the sales price, the standard price minus the actual price on the aspect of sales. Then we multiply by the units sold. Actual units sold. In our case here, the standard price was how much? When I look on information provided by the examiner, right? So the standard price was how much? Let me check somewhere. The standard price was 136. Is it like that? 136. But the actual price to use ngapi? To use a 134. And we are not happy, by the way. Because in sales, tumeuza less than what we budgeted. Hata ukiangalia vizuri wewe. Usicompare na cost. Hii now ni sales. Because ulikuwa umebudget kuuza 136, ukauza kidogo than what we budgeted. Ulipata less sales actual compared to the standard. So zilikuwa za ngapi times 36,000? Times 36,000 now. So it will be 136,000. Sorry, 136 minus 134 times 36,000. This translates to 72,000 adverse. 72,000, which is adverse there. Now let us proceed by looking on the other variance. And we are going to be having to look on the, because this is the sales price variance, let us look on the material price variances. The material price variance. So how am I going to be looking on it? In this aspect, in this case, sorry for that. In this case, we are saying that to get the material price variance, we compare the prices. How much was the budgeted and what is the actual? So the material price variance in this case, right? Let me check. The budgeted material was 10. That is the per unit. That was the price per kilogram, sorry. The actual, right, is very simple. Because we say we compare the prices. So the standard was 10 minus the actual. The actual I can see, right, we are given the totals, 754. You divide by 76, then you multiply by 76,000. How much are we getting? So 754,000, I just limit my 2,000, you divide by 76. I'm going to be getting 9.92. So I just take 10 minus my answer. Then I multiply by 76,000. I'm getting 6,000, right? Which is favorable. The other one will be, that is we have already finished with the material price. Let us look on the material usage. The material usage. It is going to be applying all the knowledge that we have. So the material usage variance, right? This we said, let us take our standard quantity minus the actual quantity. Then we multiply by our standard price. Now, the standard quantity per unit, as per the question, was 2 kilograms. So to get SQ, it will be 2 kgs. We multiply by the actual quantity. So the actual quantity was how much? The actual was 76,000. Let me see. 76,000. Right? That is the actual quantity purchased. Not the actual quantity, but the number of units produced. To be produced ngapi? How many units to reproduce? I think it was that 6,000. I saw it somewhere. So that's 6,000. So in this case, 2 times 36,000, it is translated to 72,000. Minus the actual quantity of hours. How much is our actual quantity? It is 76,000. The actual quantity is 76,000. Then you multiply by the standard price per unit. The standard is 10. So in ngapi. So I just say 72,000 minus 76,000 times 10, getting 40,000 variance. 40,000 adverse, sorry. So hapa nakuja tu naeka, it equates to 40,000 adverse. Tumemalizana na labor. Because now nimemalizana na material. Because nikichukua plus hii, ndio nitapata ile nilikuambia labor cost variance. Material cost variance, sorry. Now, let us go to this labor, the labor rate variance. We said, under the labor rate variance, we are going to be comparing between the rates. So in this case, you have to be looking at what is our standard rates. What is our standard rates? And I say, to get my labor rate variance, we have said, take the standard rate minus actual rate. Then you multiply by actual hours. So the standard rate of hours is how much? What is our standard rate? And when I look on the question provided here, the standard rate was 24. The actual hours, nikiangalia examine under the actual scorecard, amenipea two totals. I just say, let's take 26,56,000. You divide by, I just reduce to thousands, 114. Times actual hours. So our actual hours ni ngapi? Actual hours. Tumeambiwa na examiner vizuri ni 114,000 which were paid. Now, in this case, I just say 2656 divided by 114 translate to 23.29, which is less than 24. So I just take 24 minus answer 0.70 times 114,000. This gives you 80,000, which is favorable, right? 80,000, which is favorable. 80,000, which is favorable. Then let us do our last one for this reconciliation. The last one that we are going to be doing, it is the labor efficiency variance. And we said, take your standard hours minus actual hours, compare with standard rates. And then we said the standard hours is not going to be given. Take the standard quantity per unit, and the standard quantity per unit, the standard hours per unit, sorry, it is 3 hours. Times the actual units which were purchased, that 6,000, the actual units which were produced, that's 6,000. So that 6,000 times 3 translates to 108,000. That is my standard hours. I just say 108,000 minus actual hours, which is 114,000. We multiply by standard rate, which is 24. How much is this? Minus 114,000. Then we multiply by 24. Translates to 144,000. 144,000. 144,000, which is adverse. Which is adverse there. Which is adverse. So in this case, I just come and I say labor efficiency variance of mine translates to 144,000. Which is adverse. Which is adverse. I just want to arrange this question very well so that you can now be able to understand. I have already gotten everything. So that you understand, to get this reconciliation statement of yours, to get the reconciliation statement, our reconciliation statement, we have 2 kgs, Kenya shillings, sorry, 2 columns there. We start with the budgeted. Our budgeted now, the standard contribution on the actual is 1584. Take your variances here. Right? We are discussing about adverse. And we have adverse, we have favorable. We start with our standard price. Our standard price variance, right? Our standard price variance of ours to the pattern ngapi. The standard price variance, we got 72,000 adverse naeka hapa. Then we go to the material price variance. The material price variance, how much are we getting? The material price variance, how much am I getting? Let me see if I'm going to be getting the same answer. Let me start from here. Let us talk here is 1672,000. Sawa? Then hapa niko na sales volume variance of 88,000, which is adverse also, right? Then from there, we go to the material price variance. Our material price variance was 6,000, which is favorable. We have the material usage variance, which translates to 40,000, which I put here. Then we have labor rate variance. Labor rate variance of ours, which is adverse here, 80,000. Right? Then we have the labor efficiency variance, which translates to 144. So let me get the totals here. Hapa najua, the 86,000. What about the adverse? 72,000 plus 88,000 plus 40,000 plus 144,000. How much am I getting here? 344,000. Offset, because this is positive, this is negative, right? So how much is the difference? So minus 86,000, you are getting 258. 258,000. We are getting 258,000. 258,000, 258,000. 258,000. So what is our actual contribution? Let me see whether you'll be able to get my actual contribution. So what is my actual contribution? I just take 1672,000 minus my answer. Yes, and I'm getting 14,000. 14,000. 14,000. Considering these are my costs, that is why I've deducted them here. Because this is the budgeted profits or contribution. Budgeted contribution. So I plug off my costs to get the actual contribution, to get my actual contribution. That is how you normally do it. And I remember this answer tulikuwa tumeipata somewhere. So that is how the examiner tests the waters. So in this case, once you do your workings, because all these we were doing our workings. So once you do your workings, be aware that we are going to be having these variations as you move forward. So the sales volume variance nimeiweka hapa because I was able to explain to you. Here I need to get the sales cost variance, the material cost variance, labor cost variance. That is why I've included each in our calculation. Any question now? Any question? Any question? Now, because we are moving to conclusion, I'll just be able to share some assignment there with you. And this assignment which I'm going to be sharing, the assignment which I'm sharing here, would be similar to what we have done. Then from there, I will just be able to do last semester's question, which I'll be able to share to our WhatsApp group. I do that question, I share it to our WhatsApp group. I think we are not going to be coming across any other different type, any type of a question, right? Moving forward. So we are expecting to be coming across similar questions to one that we have done in our exams. So nothing different that you're going to be expecting moving forward. Any question now?
Mwalimu,